Welcome back. You're watching The Pulse here at Ausbiz. Well, we're just talking about the rental housing crisis at the moment, of course, what's going on with rents across the country. Let's go and get a bit of a deeper dive as to what's going on when it comes to the lending side of the equation with Anthony Landahl from Equilibria Finance. That is the CBO Australia 200 at this point of trading. You see it's still oscillating around that 0.75%. Let's bring in Anthony Landahl from Equilibria Finance, who I believe is standing by in our studio there. Anthony, can you hear me? It looks like we might have an issue there.
Oh, g'day, David. Yes,
Look,
I can hear
you. There we go. Now we're back. Perfect.
Yeah,
there we go. Live TV. Who would have it any other way? Look, I want to go and get your views about what's been going on from the macro space at the moment. This week in markets has been dominated by that US CPI report. We've seen a big move at the front end of bond curves, a big steepening there. What's the impact been when it comes to the mortgage market? What you're seeing in that particular area?
Yeah, look, obviously. Yesterday, those US inflation results had a big flow through to the markets. They actually came down from 8.5 to 8.3, but the expectation was 8.1, and that really flowed through. So we haven't seen any direct flow through to the Australian market yet, but obviously I think next week's meeting of the Fed on Thursday, what they do to their interest rates, there's talk of a rise of maybe up to 1%. By the Fed, that's going to start flowing through, and it already is flowing through to discussion about what the board might do in Australia in a couple of weeks when they meet. There was talk after the last meeting around maybe a 25 basis point increase. There's already talk now of whether that will be higher in tandem with the US inflationary numbers, waiting to see what the Fed does, as well as, I guess, our unemployment numbers that came out today showing a really tight labour market still. So it's a very interesting time this next couple of weeks with a couple of key dates on the radar. But US inflation needs to be kept a little bit in context. It's come down from a high of 9.1. I think the troubling thing is that it's hitting household goods. It's even though petrol went down, cost of food, electricity, they're all in double-digit growth. So they're pretty alarming figures coming out of the States.
Yeah, absolutely. That sticky services inflation as well. The things that we go and do experience are certainly pretty strong at the time being as well, and that's what a lot of concern is about there. Anthony, you mentioned the other jobs data today. What did you make of the result? Certainly a bit of something for everyone. You saw the unemployment rate going tick up a little bit, but at the same time, employment pretty strong again. Yeah,
essentially we got a tight labour market. I mean, the rate ticked up from 3.4 to 3.5%. Essentially, that was just an increase in the participation rate. We also had an increase in employment of about 33,000 people. So really, it was just an increase in participation rate. We've still got a very strong labour market, very tight labour market. The interest rate increases in Australia, the inflationary pressures haven't flowed through to wages growth at this stage. So that tight labour market remains, and I think it's going to remain like that for the time being as well.
We're just talking with Louis Christopher from SQM Research, who said that because we've got such strong labour market conditions, such full employment at the moment, that a lot of people are still qualifying for loans despite the increase we're seeing in rates. So what can you tell us about the number of conforming loans? Like, are people still being able to go and get mortgage if they actually want one?
Yeah, look, we're still seeing a fairly strong credit market. We're seeing a bit of a shift in behaviour. First home buyers, particularly, I think we're starting to see a drop off in credit. I think that's for a number of reasons: serviceability, deposit pressures, and just a little bit of uncertainty. They're probably a lot more rate sensitive right now in terms of the impact on them of the rate increases. But we are still seeing reasonably good flows from those people looking to potentially upgrade who may not be as impacted by pressures around getting a deposit or the interest rate rises, as well as investors who are a little bit buffered against those inflationary rises with, I guess, the tight rental market and the rental yields on display at the moment. And for investors, money's still relatively cheap. So still pretty strong credit flows. A lot of people are reassessing the market, looking at refinancing. End of 2023 is around about when 70% of fixed rates come off. So that's going to be a really interesting time for existing mortgage holders as well. But credit flows have definitely dropped off, but we're still seeing some strength from upgraders and investors.
Yeah, just in that variable rate space, what are some of the really good rates that we're seeing out there? Presuming that you've got like an LVR of better than 80%. What kind of levels can you go and get at the moment? Because a lot of people that I'm speaking to are on fixed rates and they're saying, Scuddy, we're going to be refinancing to a massively higher rate environment. What levels are we talking about at the moment?
we can still secure under 4%. We're still getting rates 3.5%, 3.74% with some of the second tier providers, particularly with a good LVR. But people are coming off a base of 1.89%. So that's still 1.5% to 2% higher than a fixed rate. So no matter how you skin the cat, if you're coming off a fixed rate, there's going to be quite an increase. But we're still able to get under 4%, and some providers still have some funds well under 4%, albeit they're starting to dry up, and some of the second tier providers are now starting to increase their rates after last month's increase of 50 basis points as well. So it's getting harder to secure those, but they're still available for the right loan to value ratio and using some of those second tier providers.
Mate, just to go finish off, you mentioned the RBA a couple of times. Obviously, it's been pretty busy doling out those 50 basis point hikes. There's a review in the bank, underway at the moment to go and figure out the potential, the composition of the board, voting intentions and the stuff like that. Is that what we need as borrowers out there at the moment to go and have this review? Do you have an opinion on it?
Yeah, it's a very volatile time in the market to be conducting a review. I think the main thing is we've got to make sure the review remains objective, doesn't become a witch hunt for the RBA around some of the commentary that was made a couple of years ago about rates and obviously the subsequent increases we've had. It's got to stick to game plan around making sure, looking at issues around governance, around who's on the board and around decision making, and making sure ultimately that the RBA remains independent and the RBA is able to continue to do its function of managing the economy and having input around monetary policy. So I think the main thing is that it remains as a review and it doesn't become a witch hunt around the RBA, and we get the outcomes that ultimately help strengthen the economy and the board. We're one of the few countries that doesn't have a fairly regular review of the central bank, so I think it's good timing to start that, albeit very volatile time in the market. So we've got to caution that it sticks to game plan.